Well, welcome everyone. We're glad to be back in the thick of the fall. Hopefully the weather cooperates. I know high school football starts tonight. We're excited to get the market back together, and I think today will be a great program to hear about what's ahead here this fall. So let's get going. This is our Market Matters 2 speaker series entitled Navigating the Lending Environment. So we've enjoyed a great programs over the year of 2023. We started off with Tom Ghilardi, owner of the Stars, in January. We went to Michael Dardick and Adam Sapphire in March, and then we had the great Troy Aikman in May. And so we're going to cap it off here for our last Market Matters breakfast with a great group of professionals to talk about the lending environment. So next up, just remember, we do have our final speaker series in November with Mark Gibson in our Capital Markets Update. So that's always a dandy of an event, so we're excited about that. And please let us know, or myself or Travis Reynolds, if you'd like to be a sponsor for that event as well. We're going to be meeting at the Omni, and we have many seats available, so I think we can sit up to 500-600 there. All right. Why don't our guests come to the stage? And so first off, I'd like to introduce Darcy Barnes. She's with Bank of America, and I'll be quick here because there's a lot to introduce. Darcy is the Southwest Regional Market Executive for the Commercial Real Estate Banking Division of Bank of America. She has held various roles within commercial real estate and has extensive background in origination, structuring, and documentation of debt financing for real estate sponsors. Darcy is a board member of the Real Estate Council, a TREC ALC graduate, and also helped launch the Diversity, Equity, and Inclusion Board with TREC. Darcy is a BBA graduate from Augustana College in Rock Island, Illinois, with degrees in marketing and computer science. Thanks for joining us. Tom Burns with Affinius Capital. Tom is managing director and is responsible for sourcing, negotiating, and structuring transactions focused on Texas and Western U.S. He originates bridge, construction, and fixed-rate life company loans with production in excess of $1 billion annually. Tom is engaged with organizations that includes Catholic-affiliated charities such as Christ the King School, Folsom Institute of Real Estate at SMU, Cristo Rey Dallas, and Men's Guild of Children's Hospital of Los Angeles. Tom is a graduate of Vanderbilt in economics and a master's in real estate development from Columbia. Thank you, Tom, for being here. Paul Geyer, right here. Paul is with PGIM. He's managing director and oversees the Dallas office focused on originating a broad range of commercial mortgage products on behalf of investors, prudential general accounts, and debt funds. He has more than 30 years' experience in commercial real estate finance and previously worked on loan teams with J.P. Morgan, Nomura, and Prudential. Paul's a graduate of DePauw University. We'll make sure it's not DePauw, DePauw, in Greencastle, Indiana, majoring in economics and MBA from the University of Chicago. Thank you, Paul, for being here. And lastly, our moderator, Rob Bowlby. Rob is president of GlobalPro Texas, which represents insurance policyholders with a signature process to maximize recovery of property damage claims against insurance providers. He has enjoyed a 29-year career with BB&T Bank, and most recently being the market president in Miami, Florida. He moved from Miami to Dallas in 2019 to start up GlobalPro and is involved with YPO, TREC, and also the executive chairman of Big Brothers Big Sisters Lone Star. Rob is a graduate of West Virginia with a degree in finance. So we've got East Coast, Midwest, and West Coast. Sorry, West Coast. So let us welcome Darcy, Tom, Paul, and Rob.
Okay. Thank you, Bill. So as they mentioned, Mark Gibson's going to be here in the fall, and I guess he's going to give kind of the macro overview of the capital markets. This is going to be a lot closer. This is actually how do I get a loan right now, which I think is a really relevant topic to the people in this room. And so I sit with Bill on the programs committee, and we actually started talking about this in the spring, right after we had the bank failures of Silicon Valley Bank, Signature Bank, and Republic Bank. And it was worrisome. It was, the markets were trying to determine, are we in a banking crisis? I don't know that question's ever been answered. And so I thought we would start with hearing the perspective of all of our panelists, because all of your firms were around in 2008, which was our last major banking crisis, and there's been a lot of comparisons to 2008. So I'd like to hear from our three panelists. You guys were all around in 2008. What's different this time versus 2008? And Tom, you're to my right, so we're going to start with you.
Sure. I mean, I don't think this is similar to 2008 for a number of reasons. I think the asset quality in 2008 was, subprime mortgages and a bunch of CDOs and CLOs, and this is, most of these banks are buying government securities, and it's, SVB was a management mishap with respect to duration on securities. I think underwriting standards today within banks are substantially different than they were back in that time. I mean, I think back then, if the deal didn't work, you added more IO to make the DSCR work, and your underwriting vacant office space is worth more than occupied office space. So the underwriting standards are totally different than they were in 2008 and 2009. In addition, like the Federal Reserve right now is, they're currently tightening or holding rates. Back then, they were cutting rates, a lot of quantitative easing. So there's a completely different spectrum with the Federal Reserve, as well as with the employment picture. In America, it's 3.4%. It was 5 or 7% back then. So.
Yeah, I mean, when I think about your first question, are we in a banking crisis? I think we have to kind of move away from that narrative of crisis and, really like lift the hood, peel back the onion on the strength, the stability, and the diversification of the financial institutions that you're banking with. So from my perspective at Bank of America, we have a $3 trillion balance sheet. We have $1 trillion in loans, and then we have $2 trillion in deposits. And so that's from all of our 8 lines of business. When you look down a layer and you look at commercial real estate is about $100 billion. So said another way, 10% of loans at Bank of America are commercial real estate. When you look down another layer, specifically at office is 2%. And that office typically is underwritten at, 55% loan to value. It is 75% Class A. So no doubt, there's so many challenges, and we will get through those. But when I think about, the word crisis, the other thing that comes into play are the wall of maturities or the upcoming debt, which is a challenge, right? It's a challenge for a lot of institutions, ourselves included. In a typical year, we have about $20 billion that matures. That typically is about like a 40% payoff rate due to refinancing or asset sales, and we're not seeing that. And so it's no surprise that recycling of capital is not happening, which is causing a lot of institutions not to be able to originate. So when we started, 2023, that 40% payoff rate went to about 2%. So again, said another way, 98% of the maturing debt is sticking around, and we're doing the right thing. We're showing up for our clients. We are modifying transactions, but to me, that kind of funnels into the crisis, the headlines, what we're all going through. And then to your second question on how is it different from 2008, 3 things come to mind. Interest rates, vastly different. Leverage, vastly different. But the biggest differentiator for us is our sponsorship. And so the client selectivity and who we are doing business with now are top sponsors, sophisticated sponsors, and people who have been through cycles. So
I don't know what I can add to those two, but I do think 2008 there was an asset quality issue. I think there were as Tom alluded to, they were underwritten off pro forma. We also had the credit default swap market. You had conduits and sort of these non-perfect hedges out there, all these things going on in the capital markets that were derivative-based that really kind of created assets out of vapor. You could securitize a pool of loans, but then you could also underwrite basically insurance on the bonds you just issued and sell that 10 times over. So you could completely recycle every loan you were doing or figure out a derivative based on one asset. And it, as Sam Zell used to say, it's trading sardines. These were not eating sardines. That was 2008, and you also didn't have as much equity in the market. I think since then, obviously, we have a ton of equity that's been invested in these assets, and that's a big difference from 2008, and I think something that's going to help us this time around. I think what we're experiencing right now is really maybe more of a mark-to-market play, where we've all been addicted to low interest rates since effectively the GFC, and then through the pandemic, it happened again, that maybe we should have started rolling off on. And I was at a conference in March, literally 1 week before Silicon Valley Bank started, and it was a borrowers conference where they had an old retired Fed governor. He's not that old, actually, he's well younger than I am, but it's a Fed governor from New York. And he spoke to us, and he said, in order to get inflation under check, the short rates need to be higher than the inflation rate for at least 18 to 24 months. And everybody kind of let out a sigh because we knew that the inflation rate was over 5%. And at that point, it was like pushing 6. And so if you think about that and you say, okay, here are these interest rates, that creates an amazing dynamic of a reset on value on, where does capital go? Where can it go get a 6% return when they were building 5.5? Well, now you can go somewhere else pretty easily, and you could have a 3-day trading window for settlement versus having to invest in something and take months or years to get your value back. So I think that's a huge difference that we're going through right now compared to the GFC. But there's been a lot of equity in the market, but I think we've got a big reset going on right now.
Great. Darcy, I'm going to come back to you for this next one. So you guys were a regulated financial institution, OCC regulated, I believe. And what I remember from the 2008 crisis was there was a lot of banks that wanted to lend or to help their clients, but they were just under a ton of regulatory pressure. And I remember clients that said, well, I've made every payment. Why is my loan classified? And they're like, well, sorry, the regulators classified it. So what are you guys feeling from the regulators right now? Where are they focused in commercial real estate?
Yeah, I mean, there's no question there's enhanced regulatory oversight, especially since all of the events of this year. Most recently, at the end of the second quarter, there was new guidance released by the feds on accommodations for any workout loans. And so I think the key point there is that guidance had not been updated since 2009, so for 14 years. And really what it outlines is for financial institutions to be measured and pragmatic when working with sponsors for distressed assets. And it further outlines short-term extensions, partial deferrals, and partial repayment. And then the other piece of regulatory guidance that most everyone probably saw was at the end of July, and the enhanced capital requirements for any institution over $100 billion in assets. And so while that's a proposal, and that proposal would not be enacted until, I believe, 2028, I think overall we know the known is regulatory oversight is increasing. The unknown is exactly what it will effectuate as.
Okay. And Tom and Paul, I know you guys are regulated differently, but I know you also have a really good handle on your portfolios. What are you seeing in your portfolios, and what are you kind of projecting for the next 18 to 24 months as far as any deterioration?
We re-underwrite our portfolio on a quarterly basis, and we re-underwrite our entire multifamily book. And I would say that is holding up very well. On the office side, just nationally, we wrote loans in 2018, 2019 that were office buildings that were underperforming that were going to perform better. COVID didn't help that, and so we're taking a handful of office assets back across the country. I think that theme in modifying office loans is going to continue. We're seeing it on some of our life co book as well, where we're seeing modifying loans that need more time. So I think that's going to continue over the next 18 to 24 months. Other asset classes have all performed really well. I mean, industrial is leased up, and the demand for industrial in Texas is outstanding. And multifamily done well as well. Okay.
Yeah, I'd say it depends on the portfolio we're talking about. I would say the core portfolio, which many people would maybe call our general account, but it's not necessarily just a general account. That actually is, performing very well. I think, I'll just throw it out there. It's the elephant in the room. Every lender that's out there today that knows if they have a loan on an office building, the borrower's choice for recapping that office building is to go back to their lender and try to strike a new deal when that loan comes due, because lenders really aren't trading office assets and say, no, I'll take out that deal from that lender. It's really more of a musical chairs, and the chairs ran out. But I would say that the portfolio overall has actually performed pretty well. I think supply and demand has been in balance. As you get into the more of the core plus space, and what Tom was saying, that's where he and I compete a little bit in that space, where we're doing floating rate, higher yielding business. Again, I echo that. You're going to take back some office deals, or maybe some deals that fell flat, or demand didn't really pan out quite the way you wanted. Either those are going to get a serious recap, or have to be extended, or something's going to be worked out, or they'll be foreclosed upon. But overall, I feel pretty good about it. I don't think those are very few and far between, because of the amount of equity that went into the deals originally. And I think some of the equity sponsors realize that maybe with time it's going to heal some wounds.
Okay. I'd say, though, that we get out ahead of a lot of those deals 18 months, almost 2 years out, and try and work with sponsors on them. And most of them, it's we're not foreclosing, it's deed in lieu. They're giving us the fees, and they're putting the flag up and saying we're surrendering. So it's a pretty friendly process.
I think a lot of people learned a lot from 2008.
Yeah.
It does feel like people are much more proactive this cycle than we were last cycle.
And I would add too, our sponsors are coming to us, right?
Yeah.
We're working together, and we're already looking into 2024 and even 2025 in some instances, and people want to talk, and if it's the right time now to go ahead and modify and extend or whatever the situation, we're open to that.
Okay. So all three of you have mentioned interest rates. And so, it used to be if it worked at 8%, it kind of worked. I mean, especially when you were lending money at 3 to 4%, then you'd stress test it somewhere between 6 and 8. And if it worked at all those, it worked. We're now above 8% on a floating prime rate basis, I believe. So a couple questions. What are you guys testing at when you're testing debt service coverage, or when you're underwriting? What kind of interest rate scenarios are you using? And when you make loans, what type of interest rate protection are you requiring from your clients? And I'll start with you on this one.
Yeah, I'd say in the core buckets, it's we're a fixed rate lender there for the most part. And even before all this, and when rates were, if we were lending money at 3 or 3.5% there for a couple of years, we were still stressing it on the back end at around a 6.5% interest rate with a 30-year AM. And we really didn't want to go below, say, a 125 coverage on that number. And it was easy to do so because our rates were 3 or 3.5%. Right now, we really haven't changed that significantly. Our belief is really that when you look at the U.S. growth rate, if they can get inflation under check, and if you have a real growth rate of, say, 2%, and your inflation's 2%, well, that's 4% Treasury. Then you got the spread over that. Well, historical spreads have not been 250 over or anything. So we feel pretty good that that's still a pretty good stress constant. But we're seeing deals, the acquisitions today where you're lucky to get to a 50% loan based on that metric. On the floating rate side, we're really looking more at the exit caps and where we think those might go. And so if we're exiting somewhere around an 8 cap rate on the value of the asset, and we can get the debt out at a debt yield around 8, I think we feel pretty good about it.
Okay. And Tom, before you answer, you'd made the comment before when we were talking back there that I think I'd like to incorporate as well, because it's not just interest rates aren't the only cost that's increasing. Insurance has, for a lot of clients, I've talked to some insurance agents prior to this in their commercial book, and they're seeing an average of 30 to 50% increase per year. So if you're in commercial real estate, it's likely your insurance costs have doubled over the past 2 years. Obviously, personnel costs went up. So it's like the whole operating income side, the operating income
I'd say
increased dramatically. What does that do to your underwriting?
On that, I think we re-underwrote our multifamily book, like I said, and on average, rents outperformed where we performed them, which was great. However, taxes and insurance in most markets were, we missed on that. Those were high. Net, we're still probably where we thought we were going to be. But there's an example, we had a deal in DFW where the insurance was $500 a door, and they just re-upped their policy, and it's now $800 a door, and it was, a couple $100,000 at the bottom line, all of a sudden got hit there. And so we're seeing that across all of our regions. And I think, what we did, as a, due to that increase, we basically have a sensitivity now in all of our deals as far as like if expenses go up 5%, 10%, 20%, 30%, to figure out what the corresponding debt yield and DSCR and LTV are for those deals, assuming that expenses go up that much.
I know we always talk about it, Trek. We're big believers in DFW. We think it's the best market in the country to be in right now. And so when you read articles like in the Wall Street Journal about the state of the commercial real estate industry, there's one that comes to mind where they said nationally multifamily values have fallen 14% in the past 12 months, but yet it doesn't feel that way in DFW. I mean, you still see tons of Class A units going under construction. You still see tons of acquisition. Do you all look at this market in particular differently? Do you underwrite for DFW differently than you underwrite for other parts of the country?
I can start. We, when we're underwriting, we're looking at that entire, call it $100 billion book, measuring that all consistently. So we're not giving, even though Dallas-Fort Worth, amazing employment growth, amazing population growth, we are kind of benchmarking the entire portfolio at the same rate. And for us at Bank of America, typically we've been consistent across the board, 6.5 or 6% 30-year, 8.18 constant, which historically, I guess the last 10 plus years, that's been the benchmark we've used. That's increased to more like a 7.25 30-year, and so what that results in is about a 10.6 debt yield. Okay. So it's vastly different from where we were. And I wish we could give Dallas a little bit of a break, but we're consistent across the board. Okay.
Tom or Paul, any different?
I mean, I think we're very, very bullish on DFW. We've got a number of deals that we closed here. We're working on a couple of other ones right now in the preferred equity space, as well as on the fixed and floating rate side. So we're very bullish on DFW. I'd say, like, one of your questions on the underwriting side, we used to underwrite, we don't underwrite for better or for worse based on DSCR, we underwrite based on debt yield. Kind of the first question that we look at when writing a loan is, will we want to own it at this basis? It's not like our business, but that's kind of how we look at it. And so, we were underwriting high 5s, low 6s, debt yields in most markets. I'd say that's moved up to 7.5 to 8 debt yields in most markets, and Dallas is probably like a 7.5. And we think, on a bad day, a multifamily deal trade 5.5, 6. So there's plenty of room between where our last dollar is and the kind of trade. So.
Yeah, I'd say our debt yields may not differ all that dramatically, but maybe the way we underwrite the cash flows do. I think Dallas has benefited from the growth, and we take that into account when we're underwriting. But we underwrite nationally on a very local basis, basically for that market, for that sub-market. But, insurance, taxes, everything else, where the rest of the country may not have the tax issue that we do. I would say, and there are people in this room that know this, if you're getting your tax assessed value, in early May, there's this window from like early May till July where it's really hard to close a loan on an apartment deal or a new property that just got reassessed because the initial assessments come out way taller than I am. And then they got to get negotiated down. But if you're an agency lender, or if you're anybody that's trying to underwrite cash flow, you're like, well, here's what it says, but we all know it ends up less, and it's just this mind game of like capital movement where it freezes for a bit. So that's a frustration maybe that we see here underwriting on a local level.
Yeah, I remember those frustrations. So Darcy, you've said a couple things that I wanted to circle back to. One, you alluded to the amount of debt maturing, and from the most recent statistic I read, it's I think we've got $750 billion maturing in the next 2 years, so $750 billion of debt maturing in the next 2 years. And then you alluded to some of the recent regulatory guidance that came out, which has been really positive, which sounds really positive because, to your point, only 2% of these are just refinancing. So I'd like to talk about that a little bit. Actually, let me start with Tom on it, though. Kind of what's the difference of working with an insurance company versus a bank versus a conduit in some of these scenarios? or even the worst scenario where it's not just matured, but you've triggered a default somewhere along the way.
Yeah, I mean, I worked at Deutsche Bank for 10 years, and we had special servicers, and anyone in this room that's ever tried to do anything with a special servicer, good luck. It's you're calling usually some kid probably right out of college in Kansas City, and they have no idea about your deal, who you are, the loan, or whatever. Whereas opposed to a life insurance company, they actually have a relationship with you. They're going to pick up the phone. They're going to proactively try and work with you, and we're actively modifying deals on our side, on our life insurance book. And so it's night and day, I'd say.
Okay. Paul, any different?
Yeah, I'd say the conduit business is more about the legal side and the servicer's agreements and the master and special servicer and all that. The life company side, you definitely have a relationship, and I think the communication has always been a little bit better on that side. Just the frequency of borrower discussions or asset reviews tends to be a little bit better.
Okay. I'm going to take a couple more questions, and then I definitely want to make some time to take questions for the audience, but I want to get a little further down in the weeds here. So the community, a lot of the community banks are struggling. Obviously, they are under, to your point, the ones 100 billion and above are under increased regulatory pressure. There was an article that said KKR and Blackstone Community Trust has made 0 new originations this year. So I guess the first question is, who's actually lending? It sounds like from some of the comments you've made, Paul, you guys are still lending, but I'd like to hear from each of you your appetite for new deals right now.
Yeah, I mean, look, we're still lending. We're doing bridge lending, construction lending, fixed rate lending, as well as preferred equity. And then we have a sleeve of capital that buys risk retention bonds and single asset securitizations. We're closing a data center deal right now in the market. So we're active on all of our programs. On the construction side, I'd say we probably have, for context, we did about $7 billion of lending last year. This year, I don't know, we'll probably get about 5 or so, but we're in the process of closing $1 billion plus of new deals across the country. So we're actively lending on all of our platforms.
Okay, good. Awesome.
Yeah, I mean, like I mentioned earlier, we have a large amount of maturing debt coming due, and we've worked through about half of that with our customers. And so it's pretty simple. If we're not getting paid off on, say, that $20 billion, we can't re-lend it out to the market. And so until we see some, stabilization, I think, with cap rates and, with interest rates, it's going to be challenging, if not near impossible, to really focus on new originations. That being said, I do feel there's a misnomer in the market that we're completely shut down. That's not the case. We're just focusing and showing up for our customers on the maturities. There is a small, crack in the door that we are looking at new opportunities, but to my earlier point on the debt yield, it does have to fit inside that box, especially just considering all of the regulatory oversight that we're in right now.
Okay.
I'll let that one go. There's nothing really to add significantly there. I think they covered it.
Okay. So for the loans that are getting made today, kind of what do they? You talked about debt yields a little bit different, but what else is different structure-wise? Is it, obviously more equity in those cases, but are there other things that have changed that will make you a loan, but this is what the terms look like now?
Yeah, I mean, I'd say if you ratchet up your debt yield from 6 to 7.5, that's going to just result in a lower loan to cost. So we were, call it 75, 80%, during 2020, 2021. We're now probably closer to 65 or 70% LTV, LTC, on stuff like that.
Across the board or specific to product type?
I'd say probably across the board. The other change in the market that happened, it was a short duration that it happened, but pari funding with the equity, that was happening on some deals, and we did a couple of those. I'd say now funding, particularly on construction lending, is now sequential funding, so we're seeing the equity's got to go in first and then the debt. And so that's another change kind of that's happened in the market over the last 12 months or so.
Okay. Paul?
Yeah, I think, as we put our money out, I think we're able to be selective. I think that the type of debt yields that we're underwriting today are very consistent with where we were before, but they're higher due to that stress test, as I mentioned before. But overall, I'd say spreads are up. We're lending very well, and don't really see much changing. I mean, it's kind of we're an averaging lender when you go year to year in the market. And I think that's just going to continue to roll. We've got a little bit over $110 billion of mortgages at this point, and that's a pretty consistent process of rolling and recapping and seeing things. But it's, every deal is a new deal. But we are being more selective today, I would say.
Yeah, I think it's probably a lot less competitive lending environment than it was 12 months ago.
And to Tom's point on leverage, historically, right, we would show up around the 60, 65% LTC. Now, given where we are from a debt yield requirement, that typically shows up as, maybe 45, 50, 55 on a loan-to-cost basis. So vastly different from where we were 1 year ago.
And I agree. That's the frustrating thing, is that you're looking at something and you say, okay, I can get to this debt yield that I've been lending on. But when you look at the overall capitalization of a deal, the borrower's like, gosh, I need a lot more equity.
Yeah.
But what's happening, though, is you get a lot, say maybe, we're coming out with mezz. And so we've come behind construction loans with mezzanine financing, which is kind of a new change for us, but we see that opportunity. And it may stay open for a while, may go away. Maybe it turns into preferred equity, which we would also be able to do. But it's the capitalization of the deal changes quite a bit.
Yeah, I'd say we've had a number of deals this year that we've closed where our last dollar from the credit bucket is whatever, 65, 70%. And then there's preferred equity behind us. And it's usually not us, it's usually somebody else in the market providing preferred equity behind us. To pay off deals.
Okay, let's take some questions from the audience. Anybody have anything they want to ask? I think we've got, I don't know, Travis, do we have a mic or anything? Anyone?
Stunned into silence.
Either that boring or that comprehensive, I don't know.
Okay, well, we'll keep going then. And this can kind of, we'll give you each a shot to answer this, but knowing everything we know, and don't have to give your opinions on everything, but just think about the trajectory of interest rates, just think about the population growth of DFW, think about $750 billion of debt maturing in 2023 and 2024. What does the Dallas commercial real estate market look like in 2025, in your opinion?
I'll jump in there. I think, you kind of regress to the mean, right? But you look at the slope of our growth, I don't see that ending. I think, the Texas, economy, the incentives we have, the real estate environment we're in, just the overall governance or governance. I think we're an attractive place to move to. We're an attractive place to run a business. And that growth maybe was spurred by the pandemic, or the awareness of that, or the awareness of maybe where other locations, what they weren't, in a bad environment, has helped us. But I think because of that, obviously we've had a lot of development. And so when I say regress to the mean, I think vacancy rates will be higher. Rents might continue to go up, but there'll be more, there's more supply. And we've had a tremendous amount of supply being added here compared to the rest of the country. And so I think that kind of has a way of averaging out, but it's been very good. And I don't really see that. I don't see any huge shocks to Dallas. It would have to be a shock, or have to be something totally out of left field to change that.
Okay. Darcy?
No, when I think about, I go back to the population growth, the employment growth, and if you kind of dial back to the 80s and you looked at the population, I think we were around 3 to 4 million, and now we're about 7, maybe 6 to 7. I don't see that slowing down. To Paul's earlier point, there's a lot of supply, but I think we are the benefactor of a lot of people moving here for the jobs, for the climate, for everything that Dallas is. So I see positive, continued positive growth. As far as the debt markets, I do think in the next 12 to 18 months we will see a normalization of values, which to me, once we have that normalization, that opens the door on repayments, it opens the door on new originations, and just gets that flywheel starting to turn a little bit faster.
I think very bullish on DFW. I think that the multifamily market has absorbed a number of units. I think that construction is going to slow just with the capital markets. By 2025, it should normalize with a normal pace. I think the only area of concern probably in DFW is on older office buildings. That what are they going to be like? Some of the suburban office buildings. I think that's going to be a challenge.
It's not just DFW.
Yeah, I know.
I think that's going to be a concern nationwide. Yeah. Okay. One last shot from the audience. Any questions for the panel? There we go.
Good morning. So with respect to monetary policy, I think it was just last night the UAE and Saudi Arabia announced that they would be joining BRICS. And we're seeing, the rise in energy costs, delayed impact on CPI. What's the position of each of your respective firms on monetary policy and if the Fed will keep rates higher for longer?
I'm not an economist, but I expect the Fed to keep rates higher for longer. I mean, Jackson Hole's happening today, so we'll learn more later today, but I think rates will stay higher for longer.
Yeah, we expect one additional 25 basis point increase this year. And again, I don't have my crystal ball with me, but my guess is the first half of 24 is higher, and maybe we see a decrease second half of 24, but again, it's unknown.
Yeah, I think higher for longer. Personally, I think the inflation's still there. The Fed is on top of that, trying to bring it down. You've got two things working against each other. You've got costs going up, and maybe it slowed down many parts of the economy because costs are up and they can't get it financed, or it's too much equity. It has to be invested and the returns can't be met. But yet you've got this government stimulus that's still hanging out there that hasn't expired. And so if you're a contractor or a supplier of goods, not just services, but actually just the manufactured product, there's another whole demand curve right there you can go chase. So if you've got concrete prices that don't work for real estate, go build a highway. So I think concrete prices could stay up. So I think that kind of funnels into the higher for longer premise.
Other questions?
I've got a question for the audience. How many of you have mandatory 4-day in the office in Dallas, Texas? 4 days. 4 days. How many have 3 days? Mandatory. 2. No mandatory? 5? How about 5 days? 5 days.
Wow, that.
There you go. Office.
There you go. Let me ask a follow-up question on the interest rate thing, though, because, prior to 2008, when rates got cut dramatically, I mean, the economy kind of worked at 8%, at an 8% prime rate. If we had rates for longer, for years and years, the economy work in the current interest rate cycle? I mean, if rates hold right now for the next 3 to 5 years, does the economy work? What's your opinion?
I feel interest rates are a temporary impairment, right? And so once we have normalization, and maybe it is normal now, we all need to adapt. And so again, where I can lend versus where Tom lends versus where Paul lends, like we still have capital. It might be finite at this point in time, but I think, the economy can still move on, can still move forward based upon where we are. It's just the rearview mirror. People keep looking back, and we've had a artificially low environment with interest rates
forever.
for so long.
Feels like forever.
That it's hard to change, right? People talk about change. We all are up for change, but it's hard to change. Yeah. So
those low interest rates poured gasoline on the economy, and it really took off. But given the size of the U.S. economy, if you had a growth rate of 2 to 3%, that's really pretty good.
Yeah.
Given the overall size, I mean, it's a lot of growth. But because of that, if you've got any inflation, and if the target's 2, maybe 4 is the new normal. I mean, we shouldn't really think we're going to go get the gasoline thrown back on the fire. Kind of like credit default swaps. That was just a bad idea.
Yeah. Okay. One last opportunity, and if not, we'll thank our panelists. We got one back here.
Good morning. Appreciate the panel's time. I have a question around the multifamily space. I know Paul and Tom, you guys do a lot of bridge to agency executions and did so during 21-22. Curious on how borrowers are thinking about, having agency execution done. We see them step in turbulent times, but with higher index rates. Do you see borrowers wanting to have that get perm debt right now or seek out other solutions?
I'd say for us, what we're focusing a tremendous amount of energy on is providing preferred equity behind the agencies. Where the agencies are, sizing things, it's a lot lower than where they were historically. And so with that, there needs to be kind of some gap equity. There's a lot of folks out there in that space. For us, our kind of minimum deal size for preferred equity is $30 million, so we're kind of whale hunting, if you will. But that's the space I think that you could make some money in right now.
Right. I think there's still a play on the affordable side because of where the agencies are willing to lend and mark down their spreads in order to accommodate that. But I think, it creates a recapitalization or a product of equity to come in and kind of fill that gap. And I see that probably being a part of the market segment to grow.
Okay, let's have a round of applause for our panelists.